Welcome to Right on the Money, the weekly talk show with interviews you can use to help you maximize your money and optimize your financial future. Before moving forward with any of the ideas discussed on the show, always consult your financial advisor, insurance professional, or tax consultant. Looking for financial help or a second opinion? We can help you in your search. And now, your host of Right on the Money, syndicated financial columnist and money color commentator, Steve Savant.
In this segment, we're talking about how to use annuities in retirement planning with Liz Cornell, author, popular platform speaker, and certified annuity specialist. Liz, really, people are looking at annuities more than they ever have. I mean, somehow we have arrived. Social Security is basically a annuity system. The QLAC, the Qualified Longevity Annuity Contract, the government came up with that using one of our products called a deferred income annuity. So everybody's kind of waking up to this new idea, and especially because we're going to be living longer, and I'm not really sure all my retirement. I have qualified monies in ETFs. I have qualified monies in money markets, but I don't know if the market where it's going to be. I need something for sure. I'm going to have bills in my retirement. I am.
But you have those anyway.
I have them now, but I'm going to have them in retirement too. It's not going to go away. And a lot of us that are going to head for retirement, we're looking at our lifestyle. Do we want to maintain that lifestyle? Who's going to pay for the flooring? When I'm building a retirement plan, I want to have what's going to pay my expenses. Oh, I want to go see those grandkids. I want to go on a vacation. So I need something I know is going to be there guaranteed to pick up my normal tab of domestic living and the vacations I want to see my kids and go on different trips. So I have to have this, and all of a sudden, annuities are the play.
Yeah, and I will say this, too, and this comes from, it is an industry that I love and have a lot of respect for and am very proud to be a part of, but I think the insurance industry has finally arrived. Based on the last 10 to 12 years or so, the products have evolved to a place in that they're more flexible than they've ever been, and I really think the insurance companies get it, that the consumer, ultimately, we want to stay in charge of our money. We don't want somebody else telling us what it is that we're going to do with it. We want the comfort of knowing that wherever our money is, it's going to be in a good and safe place and within a safe industry. And I think the insurance companies really finally get that, and they now understand that, yes, consumers want to maintain that control, and they really allow you to do that.
Okay, so and that's one of the things that you're bringing up in our series today is that, hey, listen, everybody thinks we're locked in. We can't move these things. They're impenetrable. Once you started it, you can't do anything about it. You know, you're really buying forever issues. But you're saying there's a lot of flexibility here that people, it's kind of a misnomer.
Oh, yeah, that is absolutely not the case. And I spend my workshops and my classes really walking people through the nitty gritty of understanding that, in that, no, the products are more flexible than they've ever been. You can get, and I've said this before, that anything that you possibly want, but you have to understand that, you know, if you're picking a product that's a little bit more liquid, that has one of those return of premium provisions, which means that as soon as you put the money in, whatever you put in, you have access to the entire time. If you pick a product that has that, though, it may not have the world's greatest income benefits. Why? Because the insurance company has to look at this on a broader perspective and say, well, of all of the people who have this product and are able to leave, how many are actually going to do that? And they have to price the product accordingly. Same thing if you have a product that has the world's best income rider, which means that it has a big roll-up and a big payout. Well, if the product is wrapped in this income rider, well, you may not be able to take your premium out immediately when you put it in, because that's what it is priced for. So again, it circles back around to really understanding that each of these products and carriers are priced for something, and you can get anything that you want to on the marketplace today.
Okay, so there's a lot of flexibility, and there's multiple provisions in different annuities to actually fit and customize to your actual retirement.
Yes, typically you have to piece a couple carriers and products together so that overall, big picture, you're getting to happen what you want to have happen.
Well, let's go back to that, because I love that. I have a certain fantasy about my retirement, right? I have a certain, here's where I'm going to take my money. Pretty much have an idea of maybe how long I'll live based on my health today and my expectation, my history of my family. Pretty much have all that down. So I can start to actually customize, if I'm hearing it correctly, customize an annuity platform, or maybe multiple annuities, depending upon what I want to do. And I could pretty much turn on and off income, get access if I need an emergency. There's a lot of things that we haven't talked about before in this regard with annuities, because it's changed so much.
Oh, yeah, yes. And especially in the annuity side of it, I guess that piece of picking products when you're going to retire is that with annuities, they just look a little bit different. A lot of people think if you're buying an annuity that you can't get growth right? Well, ultimately, it just looks different within an annuity contract. So, for example, if I give you $100,000 and you pay me back $150,000, have I made money? Yes, of course. With annuities, growth is realized in distribution of the product, and that's a really hard concept for people to get, especially when they first retire, because we get conditioned for that 30 or 40 years. We put this money into this account, we contribute it, and we like to see our monthly value or our values go up every month or every quarter. I get it. I get really excited about it. And when you go to retire, to your point that you touched on earlier, yes, a lot of people feel like you have this, I've got this finite number, and now I have to make this work. And annuity contracts are the only thing on this planet that no matter what decision anyone makes, for the most part, I can calculate it out, because all it is all the mathematical problems, if you will, for determining if a client makes this decision with this thing, this is how it affects all of this other stuff that I know without a shadow of a doubt, someone holding a gun to my head, if you will, what dollars are going to come out of that contract.
Well, if I'm looking at basically, our paradigm is changing on retirement, and part of it is it's not the accumulation of assets any longer. It's about income. You're buying income now. You're not buying. You're trying to not grow your assets. You're trying to actually to provide yourself with income that you cannot live. The number one fear in America right now today is outliving your money. And I'm thinking about when we have talked about this before. I mean, most of the female baby boomers that are in fantastic shape today are all going to be up in their 90s, maybe early 100s. I mean, that's astonishing to think. And those annuities, especially lifetime annuities, are going to pay out even if they become Jean Clement, the Guinness Book of World Records, 122 years. I mean, that's astonishing. So we've changed. It's income now, not so much accumulation of assets.
Well, yeah, and to put the fancy word on that, you said, you know, people want to know that we're not going to outlive our money, right? Well, annuities, at the core of what they are, they're insurance products designed to insure against the risk of superannuation, or the risk of outliving your money. I tell folks this all the time. Longevity risk is one of the biggest parts of planning for retirement. So not so much how much money you have, but again, really you should be looking at, you know, how long am I going to be here? And none of us have the crystal ball to know that. But really, on your best efforts, you should try to, yes, no, you can't calculate it out, but you should prepare for it and should know that. And the annuities are a great place to be able to go and do that, because at the very core of what it is that they do, it's what they're designed for.
I just want to suggest to our audience, too, remember, there are life expectancy reports. It's not a true science, but at least get you in the game and kind of establish a benchmark on when you think they're going to take your history involved, your behaviors, how you've been doing in certain arenas of diet and so forth. And that can actually get you in the game and kind of price when you think that you are going to, as you say, graduate, not pass or
get
die.
Promoted.
Get promoted, yes.
Yeah, and there's always going to be the outliers. I mean, that's just statistical data. But much of the life insurance industry's credit is they've got about 300 years of mortality tables for any reason anyone has died ever. So they're a really good place to go, because statistically speaking, they've probably got the most comprehensive data on determining how long it is we're going to be here for.
When I'm thinking about the last upgrade, I think about this in the 2001 standard operational tables. The actual average female is 88.8. That doesn't mean average so much as that. It means that half of those females will actually live longer than 88.8. So I think annuities need to be in place in a retirement, at least to make sure that I'm taking care of my domestic expenses that I'm going to have and I can't get around it. And especially a little, what I call the little jaunts you want to take, the vacations, go see the grandkids.
Well, yeah, and you can leverage income for other purposes. A lot of people forget that you get to retire because of the income, right? You have more income coming in than you need, and you save it. So the idea in retirement is if you can get things behaving in a way just like that. I retired because I had more income coming in than I needed. I saved it, and now I'm living off of it. So for us, that feels normal. Really, the idea in retirement is to get things behaving exactly that way. If you need $60,000 to live on, but you have $100,000 in guaranteed income, you don't have to spend the other $40,000.
Yeah.
If you do, great. If you don't, reinvest it. It doesn't mean that that money is just vanishing into thin air. Babe Ruth actually invested 100% of all of his money into annuities and avoided the entire 1929 blunder because of doing that. He has a quote, which I love, where he says, you know, I may take risk in life, but I don't take risk with my money. And the last hard part of it is typically left off. And he said, because that's because I invest in annuities and I don't have to worry. And his whole philosophy was that if I have more income than I need, I just reinvest as I go along. And over time, I am getting more.
Let's talk about that, because remember, an annuity contract is only as good as the carrier behind it. Talk to me a little bit about ratings and balance sheets.
Yeah, well, there are 4 basic ratings agencies that you can go to. Standard & Poor's, AM Best, Moody's, and Fitch. Now, what I actually look at is a Comdex score, which is something most people are not familiar with. A Comdex score, basically what they do is they take a numerical value. Now, an insurance company has to be rated with at least 2 of the 4 agencies that I just named. And to think that it's not political, they get rated on more than just how much money they have, how financially solvent they are. They get rated on new product, whether they like the CEOs or not, whether they like the infrastructure, if clients are complaining, if advisors are complaining, if advisors love them, if clients love them, and so on. It's not just compartmentalized to financials. So what Comdex does is they give this numerical value to the historical ratings of these companies. It's a 0 to a 100. So if a company has a 90 Comdex score, they are ranked higher or in the 90th percentile or higher than every other insurance company on the planet. So for getting a better, honest rating on these insurance companies, I encourage folks to look at a Comdex score.
Well, that's all the time we have for our show today. I want to thank Liz Cornell for being my guest. But before I go, remember what the good Reverend John Wesley once said: make all you can, give all you can, save all you can. I'm Steve Savant. We'll see you next week right here on Right on the Money.
For more information on this week's money topics, just go to our website at www.rightonthemoneyshow.com and follow Steve's daily postings on Facebook, Twitter, and LinkedIn. When it comes to retirement, money management, small business, insurance coverage, college funding, or budgeting, we have the interviews you can use.